Well, yeah, Alistair just gave some good background stuff about rationale for why it should come up out of here now because of these events going on. And I try to blindfold myself to these things because I don't know how to time them, but they are there. We know it, and you can't alter reality forever. Ultimately reality wins. And so if something's been held back for too long, it's likely that when it unleashes, it'll unleash even more than if it had been let to do it before. But the technicals are what we're looking at. And I don't just mean price in relation to like 3-year averages, 3-quarter averages, and so forth, not just day to day or week to week stuff, the noise. And when we measure it, we create an oscillator and it creates a different visual picture than when you look at a price chart. It develops its own trends. Sometimes they aren't even evident on price yet. Well, we just broke out a week ago. Silver had made, remember, over the last year, the high in silver last May was 32.70. Okay. You could draw a line sideways through a year of up, down action with two peaks after then at 35 and 35, where you could draw a line through that ink and it oscillated either side of that price level, going nowhere. It had a sharp drop, like in early April, it had a real sharp drop and immediately recovered. When we looked at momentum of that price action, we didn't get this erratic up-down action. We had a perfect tube of action. You could define, if you saw the momentum chart, which are weekend reports, it's like a perfect channel. Last Friday, when we closed up and got up in the upper 34s again, not even getting back to the $235 peaks, it broke out of a whole year of perfection of a channel, meaning it's going to unleash itself now. There was a period back in 2010 when a very similar thing happened technically, where you could find a spot and it oscillated noisily sideways for a year, and you didn't know what's going on. And momentum developed a structure, a downtrending structure of correction. And when it broke through, silver exploded over the next handful of months. My assessment is not just because of that historic parallel, but because of other factors I see in play right now, technical factors. Once we get this up, I think the first surge is not even going to acknowledge the old dual highs at 50, which really were phantom events. We were up there for so brief a time, it was like gaseous. It wasn't even really getting up there. And as you said, in real dollar terms, real value, $50 don't mean anything. We have to go to about 200 right now to match those peaks in real dollar terms. But I think we're about to launch, this month being the initial launch month, for the next 3 to 5 months. And then you may get a pause, and then I think there's more after that even. But I'm focused right now just on this jolt that I think we're about to have. And I think it's going to blast out the old 50 highs. And that's, of course, when what? You're going to get all the public, which has ignored this beast the whole time, denied the reality that was under their feet, with the monetary metals rising, beating the S&P, by the way. Certainly gold. Even the gold miners, by the way, have beat the S&P since 2015, if you measure it properly. But I think we're about to launch. And I think in the next 3 to 5 months, you'll see a different reality than what we've seen. Alistair hit it on the head there, the dollar. Now, of course, there's two ways to measure it. One is the reality way, which is what does it really buy in real world terms? When I was a kid, a loaf of bread cost 20 cents. Okay, what does it buy now? Anyway, granddad's house cost $4,000. Now it's $420,000. Okay, median price. So it's the deterioration of the money unit itself. All of them are deteriorating. But when you compete them in the dollar index, so-called, which is primarily euro and the yen, constitute like 70% of the dollar index. When you plot that beast, we made a high and a rally high in the dollar at 115 in late 2022, and then it dropped sharply down toward 100. Okay, from 23 through 24, it oscillated in what was basically an 8% range, usually 100 to about 108, 100. It was just a nothing. It was a trendless market in a very narrow percent range. It didn't create any wave effects. In March of this year, it started to roll over and got down to 104, which is right in the middle of that range, basically. And we put out a report saying, that's it, we've topped. Dollar's topped. The March close was 104.21. After that, it dropped another 5-6 points, dropped down under the 100 level. If you look at a price chart of the dollar index, you'll see that in 23 and 24, it kept making lows at 100. As soon as we pierced it, went down under 98, shot up to 101, like, oh boy, I'm going to rescue myself. And now it's back under 98 again, quietly, not real volatile. The problem now is that it's another metric that we use. We use 3-year average momentum before it broke in March. The 10-year average momentum chart, if you saw that momentum chart, you would scream. Say, we're breaking the gates of hell here. When you close out a month below 98.35, to give you the number, you will blow a structure on momentum that if you just looked at the momentum chart, you'd say, my God, a multi-decade uptrend is gone. Wakes up in terms of volatility. That's when they'll start noticing and feeling the impact of a weak dollar, not just noticing that it's drifting, but that it suddenly starts to cave. And that's when this beast, this asset category, suddenly becomes a factor in bonds, also in the stock market. As Alistair said, the number of foreign investors is off the page compared to history. So they're going to be impacted not just by a stock market downticking or stalling, but by the dollar value of it. So that's going to be a new factor in all the markets, is the breakage of the dollar index versus the other piece of fiat, the yen and the euro. Not that they're better, but they are relative to the dollar. And that will have wave effects in other markets, which have not existed up to this point. And it'll also probably help cave the bonds. Right now, it smells of intervention to me. I don't know by what vehicle, but that bond market technically, after rallying up in early April to 122 in the long-term bond futures, collapsed within 2.5 days to 111. Keeps making lows under 111, but won't get down to 110. And that happens to be important for momentum. If you get down to 110 on the bond futures, we're using September contract right now, and it's having a rally because it's up to 114. You get back down under that 111 toward 110, and it looks like technically it's ready to give a puke. In other words, the reality of the bond crisis, which has just simply been growing every decade, doesn't matter who's president, just keeps growing. The debt crisis will maybe come to become reality. Finally, it faces up to reality, and that will have a massive impact on certain stock sectors. We're watching in particular commercial real estate, which is a component of the S&P. It's a small component, but if that commercial real estate sector, which 2 months ago we had a failure of one of the biggest shopping centers in the country, shopping center complexes, 800 million or 80 million. I think it was $800 million default on debt. Now, it didn't make the headlines on CNBC and so forth, but that's the kind of event that when that occurs, it dominoes into the banking sector. And then suddenly you should quit looking at NVIDIA and Microsoft. You better start looking at the ambush coming from the financial sector, which we think is coming, largely because of the bond market, which could be exacerbated because of the dollar. It's all coming into play. No, I totally agree with what he said. The stats are there for a recession. JP Morgan's head, is saying, we're still headed for one. Technically, I fully agree with that. Our analysis of the U.S. stock market is that the drop we had in Jan, Feb, March, April was the beginning of a decline. The current rebound came from a level that we expected to see the rebound come from. We didn't know it would come back up to the highs. But when you look internally at the stock market, and again, this is important because he mentioned emotion, and emotion is going to be a factor here. Right now, the only thing that makes people smile is certainly not their credit card balance, and is the stock market is back up. Oh boy, my retirement account isn't dead. I didn't lose 20%. I'm back to even. In fact, in reality, if you look under the surface of the stock market, even the Mag 7 aren't leading the market. Microsoft and NVIDIA, even NVIDIA is not back at its highs. Microsoft made new highs, but when you go through the Mag 7, they're Deadsville. In fact, you can go back to 2022 and have bought the same stock then. So the leadership is fading. And that's important because the leadership is the leadership. And when it fades, the market will go down with the leadership. But again, we have that financial sector issue that I think is going to really come to the fore. But there's another thing. The commodity complex is one, it's very depressed. Yeah, we talk about high inflation, over the last 6-9 months or whatever. Baloney. Look at the Bloomberg Commodity Index, came from a low under 60 in late 2020. Gold had been going up during that time. Bloomberg kept going down. Under 60 and shot up to 140 on the Bloomberg. This is in early 2022. Nice move. But even that, was the 2008 high in Bloomberg was 237. We were at 140, weren't even matched in the 2008 or the 2011 high. Then we dropped back down to 100, and we've spent now 2 years doing this, nothing on either side of the 100 price level. We've got enough metrics now that say an upturn is commencing. Our final pound the table number is to close the Bloomberg any month above, I think it's 106.50 area. Okay. Right now we're 103.50 area. So I'm talking about 3%. You go up another 3% and the Bloomberg is going to blow its lid again. Now, when we look inside the Bloomberg, we have especially that market that Trump likes to tout, gasoline prices. Okay. Crude oil recently got very weak along with the stock market. Unlike most commodities, by the way, it actually broke through some floors on price. Most commodities did not do the same. They pulled back a bit, but oil blew out a floor at $65 that had persisted for 2 years on price. Dropped down to 55. This is, I think, in April. Has spent about 4 of the last 8 weeks bumping the underside of that high 64 level. In other words, under the 65. Couldn't get back through there, the broken floor. We're now at 69. Prices have boarded back above the supposed floor, saying, okay, I broke it, but I'm not staying down there. In next quarter, which is 2 weeks away, at today's high, which is above 69, expect oil to explode. This is quarterly momentum I'm looking at. We've got a structure that goes back 3 years. You can't see it on price, but momentum says, I've had it, I'm coming out of here. Well, what will that do to human emotion? Everybody thought, well, hey, he cured my gasoline prices. Isn't that great? Now, all of a sudden, your gas prices go up $1 or $2 a gallon. Because oil, when it comes out of here, is going to come out of here. The structure is too potent on quarterly momentum. And the whole Bloomberg complex is ready to go too. So it's not just oil. But that will trash people's sense of, oh boy, at least we got consumer prices stabilized now. If that doesn't hold true, then a belief structure goes out the window. Namely, hey, he's going to fix things. Okay. And then suddenly when that sentiment hits the markets, that affects the stock market. People sell stocks to increase their cash position for pay off their credit cards or whatever. But all these things come to fore and emotion becomes an issue. And it also watch the political horizon, what's going on in the streets. We forecasted before Trump won that one of the consequences, especially if he won, would be uncopacetic outcome. Well, it didn't happen. It's now starting to happen. And you get economic pain that hurts the average guy. You can't quite understand why it's happening. And suddenly, even though tariffs sort of go by the way, yet the market rolls over again. What for, right? It was only tariffs, right? No, it wasn't. There were other reasons for it to roll over. And then suddenly the gasoline price goes up. All hope out the window. And that's when you get total dark in terms of sentiment, people's participation, people liquidating assets, et cetera. That's when you get the rapid turmoil, which instead of an incremental downturn toward reality, you get a sudden chaotic downturn toward what should have been reality.